everybody to All Things Macro, episode number 12. This is being recorded on June 4th, 2026 at 8:05 p.m. Today we have Eric, Dave, and I'm Satya hosting the show for our viewers. Just to cover on a high level of some of the basic metrics on how we performed in the markets today. S&P is up 0.4%, Nasdaq is down 0.09%, largely because of the earnings from Broadcom. The stock took a hit, negative 12.56%, kind of pulled down the Nasdaq average, the tech-heavy Nasdaq average a little bit. Dow, on the other hand, is at its all-time high, went up by 1.73%, heavily propelled by healthcare and pharma. Crude is sitting at $89 per barrel. Um, yeah, and currently, just to talk about current state of things about Strait of Hormuz, right now it is still blocked as of today, and close to 800 vessels are blocked. So, uh, Trump said that we could see the blockage extend at least until the Labor Day, which is quite interesting because Labor Day is not so near. Yeah. And on some of the peace talks that are going on, Washington is saying that the talks are in progress. Tehran said they are suspended because of the conflict that's going on in Lebanon. We should see how much of those actions actually convert into peace talks, and hopefully there'll be negotiations taking place again. Like I see conflicting reports as to the talks are in progress or they're stalled. I don't know, Dave and Eric. I don't know what you're hearing, but uh, it depends on the news outlet I follow. So,
I mean, they've been saying they're close for a while.
yeah,
Yeah.
yeah. Right. So today we have two major topics we wanted to cover. One is private credit and private equity. One thing that was in news today is many investors wanted their money back from Blackstone, which is kind of one of the biggest benchmark firm in private credit. Eric will be talking in detail about what's going on there. I have some questions as to why investors want their money back and why Blackstone is saying, wait, hold on, we will give your money back, but we need some more time. So there is, yeah, there are those conversations happening. And the other thing, as you're aware, we kind of talk a lot about macroeconomics, and as a part of that, due to ongoing conflict, we have been talking about crude, and today we will also talk a little bit about how to decouple from the energy sources like crude, petroleum, etc., and try to come up with alternate sources of energy. And we wanted to deep dive a little bit on nuclear power, which is a clean form of energy. Of course, it comes with the risk elements of radiation as well. So today we will talk about the energy needs that exist, how nuclear could serve as an alternative, the risks that come with it, and also deep dive on small modular reactors and some of the research that's going on in that front. So with that being said, let's dive deep into the private credit. Eric, just give us an idea on what's going on in those markets. So yeah.
Yeah. Even to just take a step back and for those that aren't too familiar, private credit is essentially the debt side of private equity. It's a kind of a growing business that's really taken off the past like 5, 10 years. It's private equity is essentially you have like stock interests in private companies. Private credit's very similar, except you just have loans that are issued by what's called non-depository institutions, NDFI, like non-depository financial institutions. So basically, like a Blackstone or some of the other ones are like Blue Owl or um, uh, yeah. Um, and um, and essentially what we've been seeing the past 2, 3, even like 4 months is there's been a lot of redemption requests. So these often are not publicly traded funds, and they have caps on the quarterly redemption. So let's say you have $100 billion fund. Typically, these will be capped at 5% redemption requests per quarter. That's contracted in when you become an investor. But what we've been seeing over the past quarter or 2 quarters is a lot of investors have been kind of running the back door, trying to get out of these investments. And you've had redemption requests well over 7, 8, 10% in some cases for some of these funds. Um, a lot of it is predicated by the fact that there's higher default rates. There's been growth in what's called uh, PIK interest, payment in kind. So some of these borrowers even have the option to defer interest payments till the end of their loan. And so instead of, paying the interest normally on schedule, they say, no, we're not going to do that because we don't have cash on hand. It's in our agreement that we can take this option and basically just add that interest to the principal portion at the end of the loan, and just further increase that balloon payment. To add on top of that, this coincides with the quote unquote SaaS apocalypse that we've seen in February. A lot of these private credit funds have an incredible amount of SaaS exposure, but then also what's called quote unquote business services, which is also another fancy term for SaaS. The reason why there's a different term for that is there's what's called concentration limits within these funds. So you can't have more than, let's say, 10 to 15% in one industry. Typically that depends on what the manager special quote unquote specializes in. So if it's like a manager that specializes more in healthcare, they'll have more healthcare as their largest holding. But then second to that, typically it's tech services, and then the third is usually like what's called like business services. But it's typically also SaaS related. And yeah, so a lot of this had coincided with the SaaS, but again here the article that we're referencing is yeah, Blackstone for the second quarter in a row had seen redemption requests well over that 5% limit. So this time they hit 10% of their $79 billion fund, and the previous quarter I believe it was 7.9%. So you're seeing a lot of kind of flight to safety per se. These are not liquid instruments, and then the underlying companies that are borrowing this paper are typically like middle market, lower middle market. So companies that earn lower than $100 million of EBITDA, adjusted EBITDA earnings. If you count that as true earnings. So that's a little bit backstory there. We've seen public markets have continued to make higher highs, but at the same time, beneath the surface, there's a little bit different story within the private credit markets there. So something I continue to see come across the news streams. It's not talked about as much these days as it was during February, early March for the SaaS apocalypse. But
Uh,
just kind of wanted to bring that up there this week.
Eric, just taking a step back. So why do these markets exist?
Yeah, that's a good point. So these markets kind of grew out after the great financial crisis. There had been a lot more regulatory scrutiny for banks, and so the lending standards had been tightened up, and
Mhm.
that created this sort of opportunity for non-bank institutions to take on quote unquote like riskier debt. Um, find companies that a bank normally wouldn't lend to, and then they would lend to that bank.
Do they
To,
expect equity or interest?
so
Are
you
they like
expect you
bank?
expect interests. So typically it'd be like this. Let's say there's LBO. There's an equity portion that'll be held by a certain company, and then there's then what's now known as like a kind of like a club deal or a private credit loan that's not issued by a bank but issued by one of these private institutions. and that is typically at a higher yield. So a bank would lend at, let's say, the overnight rate or 3-month overnight rate plus like 3.5% to like the most blue chip customer.
Mhm.
For this type of customer, the bank would probably want like 10, 11% over on top of whatever the overnight interest
So,
rate is.
so it's just
But
interest that they're demanding when they lend.
yeah,
Okay.
but
Yeah,
typically
private
that's
equity, they would be looking for equity, and this is private credit, so they're just looking for interest on a loan. Is that
yeah.
right?
Got
And
it.
they're
Okay.
basically understepping these banks. So instead of offering like overnight rate plus 10%, they'd probably offer like 5% to 8%. Um,
Because
and
because
yeah,
they're taking higher risk, right?
they're taking much higher risk, and then some of it again because of like regulatory standards may not be able to be
Hmm.
taken on by the by the banks. Two things to kind of caveat. So these private credit firms will then kind of package up these loans into investment vehicles and then find parties, most likely insurance companies or university endowments, to then sell off that loan interest to. So instead of university endowment buying into a bond fund, they'd maybe buy into one of these private credit funds because on paper it has lower volatility, but a lot of that's because these don't trade in public markets, and so
Yeah.
it's really like false. It's a false narrative there. And then on the other side, I lost my train of thought a little bit there. On the other side of the oh yeah, on the other side of the coin, yeah, I lost my train of thought. But I'll kind of leave it out there
Yeah.
and then yeah, we can continue to talk.
So should we should we be worried that a big firm like Blackstone is getting having their investors seek their money back? So I'm sure there are smaller firms as well. Should they be more worried? And is there going to be a domino effect in this industry as a whole? I have that question. And the second question is, why are investors asking for their money back? Are they seeing better opportunities where they could invest elsewhere, like given everything that's going on in this AI space, like or I know there's this whole IPO market that is going to take off in the next few quarters in here with SpaceX, OpenAI, Anthropic. Like I just wanted to get
It
clarity.
sounds like they're afraid of large default in these credit
Is that
portfolios.
is that why? Or
Yeah, they're afraid of these large defaults. There's already been some increase in default rates. And then again, that the increase in what's called PIK interest loans, where the borrowers may not have defaulted. Traditionally, they should have defaulted because they're not making interest payments, but because they're essentially saying, "Hey, we're not paying you this interest now. We will pay it at the end. Don't worry, we're good for it." Which in theory, the only way they can repay that at the end is if they can either get bought out or refinance. Um, so there's a combination of those two things right now, and then again the SaaS apocalypse. But uh, I remember what I was going to mention earlier is a lot of the ways that these private credit firms are able to increase their returns is to pursue what's called a back leverage facility. So even though traditional banks cannot do these deals themselves, they can lend to these companies that are then going on into the next step and lending to the private firms. So there's a lot of hands in in these pockets. We talk a lot about kind of like circular transactions with OpenAI and Anthropic, all these things. There's a little bit of that going on within private markets from banks then lending to these private credit firms, which then lend to these smaller companies, which are typically like SaaS, smaller companies, more exposed to economic cycles and have been like kind of what Dave was saying, experiencing increased default rates, not paying their interest on time, and so the investors are seeing a lot more opportunity out there in the market. And we talked about increase in bond yields the past, I believe maybe last week or 2 weeks ago. You have to consider these investments on a risk adjusted basis. So how much return are you getting per unit of risk? And when you take that into account and you have rising defaults, it's an easy story to say let's move our money somewhere else. Let's get out of this early. The last thing to kind of put a flag on here is that the underlying loans are they're private. They don't trade. The companies are very small, privately held companies, and the way that, let's say Blackstone is able to do these redemption requests, it's really difficult because that money, it's like the movie It's a Wonderful Life. That money is not sitting in a bank account. That money's in Dave's house and in Satya's house. But instead of homes, these are just little recurring
SaaS
revenue
businesses.
companies, SaaS businesses, business services companies, something that does IT services that can easily be five coded away, to be honest. So that's where when you see these redemption requests that are well over the limits, you have to think about how are these private credit firms going to fund these redemption requests? Are they going to sell the underlying loans that are most likely, you know, the real value on those loans is probably like 50 cents on the dollar. Um, no, so they're gonna have there's been some there's some funds out there like I believe it's FSKKR or KKR. They have a private fund that they had to issue debt from another fund to then convert that to equity to then meet those redemption requests. So there's a lot of concerning things going on there in the private markets that haven't really been talked about a lot, but there's a lot of news stories still coming
Yeah.
through and reporting on this publicly.
So you mentioned something interesting. Sometimes banks also lend money to private credits and they invest or lend it to
I think
others.
they
So
lend money to a middleman,
to
Yes.
to
sounds like.
okay. And initially my question was, will that lead to a domino effect within the private credit
I,
industry? But now you're saying that there could be banks also involved into this. Do you anticipate any domino effect in a way that one could affect the other in a very negative way, and now everyone gets worried and want their money back? And do you see any trends that are concerning, or because at a macro level, given how the stock markets, I know stock markets don't define the economy in any way.
yeah.
Are we seeing, like, should we be worried? Is my question.
Yeah, I think you should be worried. I don't necessarily I can't say whether or not it could be a systemic issue if you see like incredible amount of default rates, but this is publicly available from Moody's from their website. It's a little bit old, it's from October 25, but it talks about U.S. banks' private credit loan exposure nears $300 billion. And
Hmm.
so when you just look at who is involved, it definitely is a domino effect here. Um, but it's kind of a growing category within financial markets, and there's not a lot of regulatory scrutiny on it. That's how it's been able to grow. And the last time we saw debt instruments that didn't have a ton of regulatory oversight, uh, you know, then became movies such as Big Short and um, all those. So
I will
I
say
def
not to 100% parallel, but the mortgages were more, I would say, systemic than SaaS companies are. The
yeah.
SaaS companies go under, I think what you're saying is that they could pull banks down too, but I don't know. I don't feel like, well, you answer, I guess. Banks are not as exposed to those as they were to
No.
mortgages back in 2009.
Oh, that's good to know. Then that's
Yeah.
a good thing, right?
Yeah, it's much smaller, but yeah, it's definitely something that within, financial markets, capital markets, it's still flying under the radar. The Federal Reserve has been, publicly speaking about maybe looking into this more. But when you compare and contrast U.S. capital markets to, let's say, like European capital markets, a lot of European banks actually have very little to no private credit exposure. So it's kind of interesting to see the different takes from U.S. and European markets there. But again, to contrast with today the Dow made a new high again, and S&P and Nasdaq have continued to chug along the past 6 months. It's very interesting to see different stories going on within overall capital markets, especially on the debt side, which usually doesn't get talked about as much.
Right. That's a great summary. So now we will switch into energy. So, the conversation, I think, will now move from talking about molecules in crude to atoms, which is nuclear. So, let me just share my screen. I made a little presentation, obviously with AI, so I don't want to take
Excellent.
any credit. Cool. So I just are you able to see my screen?
Hmm.
Yep.
Okay, so just to give an idea about how much power is consumed, as you could see on the screen, residential occupies like 37% and commercial is at 36 and industrial is about 57%. And if we look at how this energy demand is being met, we can see that 41% is coming from natural gas and 17% from coal. Uh, I think combined close to 60% is coming from crude, natural gas, petroleum, and all the carbon, all the carbon emissions. Uh, and as you could see, renewables account up to 24%, and nuclear is 18%. It's not less, not more, but yeah, it is one fifth. So yeah. So if we look at as this is another graph to talk about the U.S. Energy demand. As you could see, it's been almost flat until as you could see in most of these trends from 2005 through 2015, and now it's slowly spiking up. And if we wanted to understand where this extra demand is coming from, it is from 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 what I understand, it's coming from the electricity demand that the AI and the data centers uh, are needing because of this whole AI revolution. As you could see, the demand is projected to be around 580 terawatt hours by 2028. So this spike in energy demand must be met by some energies, like some form of energy source. And if we look at look at and and there are reports that say that okay, given now we are constrained by oil, and also if we think about solar industry and solar energy, a lot of solar panels actually come from, they're not being produced in US right now. We are actually dependent on other countries. Mostly, I think close to 85% of the solar panels come from China. So if we wanted to completely decouple from other countries and come up with some clean form of energy, I think nuclear is the way to go. And as you could see right now, 18% is already met from nuclear energy. And one few advantages. The thing is, it doesn't emit any form of carbon or any form of
No pollution other than the
pollution. Yeah,
radioactive
yeah, no pollution. That's the right word. Yeah, no pollution.
radioactive
I
waste.
don't want to say waste because the radioactive waste still exists, and the fuel is very dense, and it has low carbon, and and the supply chain. It says hard to copy, but that comes with its own constraints because it's hard to create. So yeah, as you can see, yeah, there is going to be 160% increase in power demand that's coming from data centers by 2030. This is an interesting metrics. And here are some of the companies that the big tech companies are signaling right here. And just moving to some of the stack that makes up for the nuclear energy. Obviously, there is the fuel that is needed, which comes from uranium mining. The reactor technology. This is SMR, meaning small modular reactors and advanced and large scale reactors. And then and then the demand comes obviously from some of the cloud providers and data centers. Yeah, and from small size, small modular reactors, think of these as something that can be assembled at any place. So there could be we can an oversimplified version is a big scale IKEA dining table. So all of the parts will be packed and they can be exported to any desired location where there is a data center, and they should be able to assemble it in a safe and secure space, and that nuclear reactor will be powering the data center itself. So yeah, as you could see, there are different kind of modular reactors from 10 megawatts to 1000 megawatts right here. And as you could see, just to put things in perspective, so a 100 megawatt small size modular reactor can power up to 75,000 homes continuously. So and as you could see, yeah, a single 300 megawatt small modular reactor can roughly cover 255,000 US homes on an average. And they can, as you can see, they can provide one to power for 1 to 3 AI data centers as well. Um, yeah, and just some more information on small size modular reactors, 24 by 7 power, small footprint, modular growth, and clean power. Um, and then if I take a look at some of the companies there's a lot of private investment also that is going on in nuclear industry right now. So as you could see in here, there is all of these companies existing, the Constellation, Vistra, Duke, Southern Power, and from a fuel cycle standpoint, Chemco, Centrus, Uranium Energy, and other ETFs. And then there are from small modular reactors, we have NuScale, Okio, X Energy, Equipment Services, BWX Tech, GE, and Westinghouse, and there are some private lenders as well. So there is a Genesis mesh mission that was started by the government to kind of propel and accelerate the work that is being done on nuclear energy. So it is an exec order to combine all the national labs across the country to share their knowledge and to share their intelligence, computing power, and also some of the information, because these labs originally, actually, they are kind of siloed in their own way. So, but this act kind of compels them to share their knowledge. So the main the the three pillars of the for this mission, which is American Science Cloud, the transformation of AI models, and autonomous closed loop laboratories. So why is the government doing this? Again, this is to make sure that America continues to be leader in the AI, which is currently very much constrained by energy. So this will give the energy dominance that is needed to accelerate. To accelerate that work. And obviously some of this is tied to national security as well, and the supply chain independence, like when it comes to nuclear, a lot of it has to do with supply chain infrastructure as well, and this is still in works right now, and there are like as we try to understand more about nuclear and the constraints that come up with building any nuclear plants, it is heavily constrained by supply chain and the people with the right skill to enable nuclear power plants or build the power plants. So yeah, that's everything about nuclear. Dave, you have any thoughts?
Yeah, I mean, just a few more. I was going to zoom out a little bit and just think about, um, you know, a lot of times in tech companies, we talk about a tech stack of like what you're going to build your technology off of. And it does seem like all the largest tech companies, right? the tech giants are in the AI race, and a part of their stack is power, right? Where are they going to get power from? It's a big part of their strategy. So there's a lot of infrastructure plays to build data centers and to get power to those data centers. Whether that power comes from nuclear or natural gas, people have different strategies. I think was it Microsoft recently partnered with Constellation to guarantee that they would buy power from the Three Mile Island plant they would restart. Um, I and then Elon Musk's plan obviously is to launch satellites, data centers in space, and I think he has some kind of cooperation with Google on that. Like they both want solar powered data satellites in space. So I think that nuclear is going to be one of the strategies that we see probably do pretty well. The big problem is waste, and there's a lot of fear around nuclear waste. I think that it's, not totally unfounded because, we saw like Fukushima, like you said, where nuclear was on this kind of comeback of being very safe. And certainly Japan is pretty good about running things, safely. But they had, the worst meltdown in history because of a natural disaster. So like out of their hands, right? Um, but as we see energy prices go up, we're going to see more competition,
Mm-hmm.
and we're going to see nuclear come back into that equation for sure. Whether that's in these small nuclear reactors, the small modular nuclear reactors, or we're looking at large power plants like Three Mile Island. I think that because of the easy like fluidity of energy, meaning energy can come from anywhere, any source, right? Whether it's solar or nuclear, that the demand is going to increase that the attractiveness of nuclear across the board. Yeah.
Yeah, it'll be interesting to see how all of the nuclear strategy plays out. I'm not trying to create any conspiracies, but I hear a lot of nuclear scientists around the world kind of disappeared and kind of re-emerged at the Lawrence Livermore labs. So there's a lot of work going on to get the small modular reactors in scale to make sure that these components are made quickly and be safely exported to wherever they are needed. And apparently, China has already worked on getting some of this ready, and they have like close to 140 nuclear reactors already up and running or under construction. So I think US wants to do something similar at a larger scale. So yeah, and
Right. And there's an alignment there too between tech and government. Everybody
Mhm.
kind of sees AI as this prize to win.
Yeah,
So there's a lot of alignment across the board to
hmm, yeah,
power them.
yeah, yeah. And yeah, we'll see where all of this leads us. Yeah, obviously the fears, some of them are real. Yeah, like you mentioned, Dave, there's the Chernobyl that people have in their mind, and Fukushima that could be because of the tsunami. And hopefully, as we get more creative on how we manage the waste, and also when there is higher demand for some of this. I think there will be cost justification to be taking some of this risk to meet the needs. So,
The
Eric,
other thing to remember too is that like, residentials will also be typically competing for the same power that the data centers are.
yeah,
So the data center increase in demand is going to push on everybody,
hmm,
which is going to ultimately push again on politicians,
that's right. And nobody's happy about increasing to see their power bill go up, right? So
right?
Politicians are pretty aware of that, and they wanted to make sure that the demand for these data centers is met through an alternate source, making another case for nuclear. So yeah, again, I mean, we are not saying this is the path forward. We're just saying that this is being actively being studied across the government and also capital markets. Eric, are you seeing any interesting trend in the markets in this space, or have any comments?
Yeah, I would just say like go back to Dave's point. Yeah, Microsoft making investment, Amazon making investment. You've seen these large mega cap companies, going into the energy space. So, yeah, there's an incredible demand for power. I believe, there was someone on CNBC that was saying they think there's going to be like a 10x demand in power between, now and the next 10, 20 years,
Mhm.
which is
I
like
would agree with that.
unfathomable. But yeah, the way things are going right now. I think the comment after that was, the U.S. couldn't even really handle like a few percent increase in demand over that time. So to even think of a tenfold increase, yeah, I don't know how they're going to do it, but a lot of that's just coming from these mega players that have the money and can make those investments and resources.
Yeah,
It could be a great thing too, because they have the money, like you said, and they can put in these very expensive infrastructure projects. Um, yeah.
yeah. Cool. All right. With this, we will end episode 12. Thank you, everyone, for joining. Hopefully, you learned something from our conversations today. Thanks.